In this video, traders are going to look at short selling. What is it and how does it work? Stick around. Hey guys, a very warm welcome to you. Alright, so short selling can seem a little bit confusing. Like, how do I sell something I don't own? How do I profit from a falling market? Hopefully in this video, I'm going to explain to you the whole process behind it, the steps that go through it, how it all works and how you make money from a falling market. So if you didn't know, short selling is making money from a falling market. If we look at the equities, i.e. stocks or shares, UK stock exchange, US stock exchange, it doesn't matter. What we're looking to do is sell something we don't own, and I'll explain how we do that in a moment, and buy it back later. So if we think the value of a share price is going to fall, then short selling is the way that we profit from it. Let's look at an example, then look at a walkthrough. So let's say we think this market's going to fall. They're not doing so well. We think the share is going to struggle over the next year. Currently trading at 100 pence. UK share quoted in pence. Could be dollars, could be whatever stock exchange you're trading at. In this example, 100 pence. Now, we decide to short 10,000 shares at 100 pence. So 10,000 shares times by 100 pence, which is £1, it's 10,000 pounds of value of that asset. So at that point, the value of the asset is 10,000 times by our £1, 10,000 pounds. Bear that in mind. Now, the price over the year declines. We're correct in our thinking. Our short sell is making money. We decide to close the short or cover the short, as it's called, and we buy back those shares. Same amount of shares, 10,000 shares. This time the price is 50p. 10,000 shares times by 50p, £5,000. The value of the asset at point 2 here is £5,000, 10,000 by 50p. Right, so we understand that concept of the value of the asset falls. We're making the difference in the price of the asset at that point and this point. Where I think the problem comes in, and we're going, oh, what's going on, is the process behind it. So I'm going to talk through that in a moment. But just to reiterate, the value of that asset, which is 10,000 shares, that's our asset at that point, is £10,000 because it's trading at 100 pence. The value of the asset when it's a year later, same asset, but it's valued at half what it was because it's 50p now. The company's halved in value. Shares are trading at 50 pence as opposed to 100 pence. It's £5,000. So you're buying the same asset for lower and you're profiting from the difference. So how do we do that? Right, let's have a look. So point number one, you're sitting there, you've got no pounds and you've got no shares. Right, those are two things you've got, but you decide you want to short sell this specific stock, this specific company. So you now need to sell those shares, sell shares that you don't own. Now, if you wanted to buy the shares that would be going along, you're just going to go in, you want to spend your money, you're going to buy those shares, right? But you want to short sell. So to short sell, you have to borrow the shares from somebody, because what you're doing is you're borrowing the shares, you're selling them, and then you're going to buy the shares back and repay that asset. So let's look at the example. So now you go along at this point here, so you've got no pounds, no shares, you want to get to a point where you've got 10,000 shares to sell into the market. You then go to somebody like a fund, like a pension fund, who doesn't care what happens in a year, who doesn't care what happens shorter term. They've got it for a longer term, maybe they've got it as a dividend, it doesn't matter, they're not bothered. But what they will do is they will say to you, you know what? I am happy to lend you or loan you those 10,000 shares, but I've got a few criteria. Number one, it's going to cost you, let's say 6% per annum. Could be 1%, could be less, could be as high as 100%. It could be higher than that, depends on the company. But let's say it's cost you 6% per annum. So 6% per annum, and you have to pay that to me daily. So you have to divide the total cost by 365 and pay it to me daily. And the other thing is I can call them back at any time, and I can give you, let's say 3 days notice. Those are my terms. Are you happy to set those terms? Yes, I am. Right, okay, so they'll then loan you that asset. That asset is 10,000 shares. Imagine that going to you, fine, you say, thank you very much, there's a loan, I've written the contract out, I'm going to pay you to borrow that asset bit by bit every single day over the amount of period of time. You can have it back whenever you want. So it's just like if you were borrowing money from a bank. A bank would have maybe similar terms, maybe slightly not quite strict, but they would say, okay, you've got to pay me an interest every month, but you've got to repay the capital, like an interest-only loan, right? You have to pay the interest every month, and then they can call it in whenever they want if that was part of the term. So that's what's happening. You're borrowing an asset, you're paying an interest charge to have that. So you have now got You got 10,000 shares, great. You've still got no money, but you've now got also the contract to pay back those 10,000 shares. So what you want to do is you want to go, right, I need to sell those into the market. So this is a separate transaction now. You now go to the market, in this case London Stock Exchange, you take your 10,000 shares, you've got them, you sell them into the market. It's currently trading at £1, so what do you get for those? You get £10,000. So all of a sudden you've now got no shares because you've sold them, they're gone, but you receive £10,000 for those shares. So you're sitting now on £10,000, no shares, but you still owe Mr. Fund over here those 10,000 shares. So effectively you got 10 grand, but you still owe 10,000 shares. Great, now you're in a short position. The market falls lower, and what happens? The market goes down to 50p. You think, great, I want to cover this short position now. I want to take my profits and repay the shares. So what do? You've got your £10,000 still, you haven't got your shares, you still owe this guy shares. You're paying your fees as you go. Now, it gets to here and you go, right, I need to buy those 10,000 shares back. It's currently trading at 50p, remember? So how much you've got to pay to get those 10,000 shares back? You've only got to pay £5,000 this time because the value of that asset has halved. So you take £5,000, you buy back those shares. So now you have your 10,000 shares back, and you've got £5,000 because you had 10,000 initially, but you've used 5 of it to buy it back. So you've got £5,000 and 10,000 shares. What a better position you were in, because before you had £0 and 10,000 shares. Now you got £5,000 and 10,000 shares. You still owe that guy 10,000 shares back. Great, okay, so what you do is you give him his 10,000 shares back. You get to keep that £5,000 because all he wants is 10,000 shares back plus the 6%. You now have the £5,000, no shares. You've had to pay your 6% cost, so you're a little bit less than 5,000, but you're now back to exactly where you were at the beginning, but you've made a profit. He's made a little bit of money from that. Yes, he's probably not happy with the fact that it's halved, but he wouldn't have loaned them out to you if he wasn't thinking longer term. He's thinking long term. It's just an extra way of making some income from the shares that he holds by loaning them out to short sellers. So everyone's winning from this transaction, so to speak. Now, if you were wrong, and let's say the market had doubled, then of course you've got to buy that asset back. It's going to cost you £20,000 to buy the asset, because if it's gone to £2 and you could buy 10,000 shares, it's cost you £20,000. So it's going to cost you £10,000 of your own money to buy that back. You're going to have lost £10,000. So you can see here that ultimately this is what happens behind the scenes if you're short selling. You're borrowing an asset so you can sell it, and then you're trading, looking for the value of that asset to fall so you can buy it back later at a lower price and give it back to the owner, who's just happy to do that because he's looking for a much longer term. He's not bothered about the short-term fluctuations in price. He's got a longer term view. It's a bigger portfolio. Maybe he's looking for different reasons, etc. So he's just happy to make an extra 6% on his money there. All right, guys, so that's short selling. Value 1 is the important thing. Value 2 is the important thing, and thinking of what you own and don't own throughout the process. So you've got no money, no shares, then all of a sudden you've got the shares because you borrowed them. Don't forget you've got that contract to pay them back, so you don't really have them, so to speak. Putting in the market, you haven't got money. Again, the money's not really yours, even though it is, but you still own the shares that are in the market. They become less in value, decrease in value. You buy those back, pay the guy back, pay his interest, you keep the difference. That is short selling. Take care. Bye-bye.